Good afternoon. Welcome to Green Bicep Signal from the Noise. This is week number 5, and we're here to educate, entertain, and I'm here to drive investment ideas. The market was up last week, which was nice. But overall, there was some unknowns. Germany economic data came in weak, same with Sweden, and the US actually economic data on the inside was actually weaker too. So there were some red flags. Interesting enough, the Fed is meeting and they will make a rate decision tomorrow. And then again on March 21st, 22nd they meet. So on the 22nd they'll make a decision again, and then on May 3rd. And then I think the last one's in mid-June, around June 14th, I believe. So that is March 22nd and then May 3rd. The calm before the storm. The Fed is data dependent. They're targeting a terminal rate of 5 to 5.5%. So that's essentially how high they want to raise rates to, approximately. And that implies about 2 more increases. They could do a surprise 50 tomorrow, which is not impossible. And then they would be done and hold steady. So that could be what we see tomorrow. Interesting enough, the Bank of Canada raised rates 25, but they're done raising. So that's a positive. So I believe the Fed will hold steady the remainder of the year, or for a while at least, unless the economy really starts to fall apart. And the reason why I say that is because that's what they have said. So you don't want to fight the Fed. And that's what it says. So don't fight the Fed and wait and see. And another thing is, has the market priced in a rate cut already before year end? And I've heard on Bloomberg they were talking about that 2 cuts have been priced. And so if we don't get 2 cuts, what's going to happen to this market? That's why I have the calm before the storm. So what does this mean? The market will likely trade in a range. We are going to be range bound for a while, likely at a slight angle down. I mean, we're going to go up and down, and big down and up. There, that's the full year. And then, so what do? We find strength. That is relative strength. It's a technical thing. Typically, the simplest way to know where money is flowing is following relative strength. You do that, it will not lead you wrong over the long term, especially on a larger time frame. When you look at a technical chart, when you look at technicals, you could look at a chart which takes data and it graphs price point. Ultimately, all the information all around the world determines that price. That's why they call it, there's a thing called the efficient markets hypothesis. Anyhow, the relative strength takes that price and graphs it, and you could compare that stock or ETF to another unit. And that unit may be another index. And that will show you how well you're performing that equity or whatever you're measuring. And the thing about it is the market shifts pretty quickly, and they recognize good companies quickly, and they tend to outperform. So by using relative strength, you will outperform. Try to keep it simple. The new normal, war. Why would I say that? Well, there was some explosions. That's quite common, I guess, in that area, from what I hear. But I don't really know if that's true. But there were explosions this weekend, targeted. Yeah, and so things are escalating a little bit, but there was not a lot of news about it. China, January is almost done, so the folks are ready to go back to work. That's kind of exciting because that means things will start to open up, truly. And sure enough, PMI data came in last night around 9 p.m. And look, we broke through 50. This means expansion. Expansion means growth. And then we also have China non-manufacturing PMI. This came in extremely high. In 54, and that signals expansion. So for this to happen, I mean, obviously they opened up, but at the same time, I would imagine loans are starting to get pushed through the system. I haven't seen it in the data in China. And this is important because, well, it's important for many reasons, but if China gets hot quickly, it could artificially push inflation up. It's actually real inflation, but just because it's being pushed artificially through a lot of fast, hot loans, it could cause issues in the second half of the year And that's where inflation kicks up again and the Fed's forced to raise rates again. That's why they're going to hold steady unless we see some sort of financial meltdown. That would be the wise decision, in my honest opinion. When you look at sentiment, all these other things are looking nasty. But it's likely they're going to actually wait for things to happen. And here's an interesting one. This is the looking at the 5-year minus the Fed funds rate. And typically when that goes negative, it's a sign that the Fed is wanting to pivot. And then once it gets very negative, you can see in 2000, it was around here they pivoted. It's hard to tell from this chart, but I think it's about a good guesstimate. And then it kept shooting out. And then I believe around this time they pivoted. And so we're almost there, actually, from that perspective. But saying all that, do we know the Fed's true agenda? So if everybody's presuming it's just inflation, but there might be more things going on. We have a war with Russia, right? I say we because we're supplying a lot of weapons, and same with Germany supplying a lot of weapons. And then you have Israel dropping drone bombs all over Iran, plus F-16s, using Azerbaijan as a hopping point. And then so there's the tensions over there between Iran, obviously, and that country, then Turkey, and so that's heating up as well. We haven't heard much about Taiwan, but that'll probably come back in the news. And there's a lot of news about tariffs on China. I don't like some of this sentiment. I mean, I understand we got to be smart about China, but you got to be pragmatic too. And when I say that, the United States, we have military bases all across the world. We have these giant ships floating all around. China doesn't. China's trying to build a Belt and Road Initiative. They're trying to expand their influence. And maybe I'm being naive on the situation, but that's how I see it. I mean, China has a lot of problems at home, just like we do. So the week ahead, Wednesday, we have the Fed. Boom, Powell's he's gonna be magical, right? He's gonna hold firm, raise it 50 bips, maybe. Then the Bank of England is on Thursday, as well as the ECB. So collectively, the world is raising the cost of money. When you raise the cost of money, it ultimately raises the cost of goods. So it creates inflation, in my honest opinion. Industrial production in South Korea. I put this up here, it makes you think a little bit. 7.3% year over year. We saw how Intel missed earnings. Boom, Intel got whacked pretty good. AMD, they were actually up after hours. I took a quick peek, but then I looked at their fundamentals, and this company is just, yeah. So, saying that, we got industrial production in South Korea is down 7.3%, and you got it. So the Fed sees this. So what is their goal with what they're doing? And that's, do they want this to get worse? Do they want to weaken that region since the U.S. is sustaining stuff? Are they going to hold it longer? Are there more objectives here? I just think we need to think about all those things, frankly. Because everybody's just looking at data. Yeah, anyone can look at data. You got to think about it a little bit. And you hypothesize, and if you have networks around the world, you could probably feed into those governments and get even a better hypothesis what might happen based upon back channels communicating, assuming all this stuff goes on. So tech stocks. So last week, Tesla, MasterCard, Visa, Intel, they came out. Tesla outperformed them all. Boom. And the simple explanation is Elon Musk says it's going to be the most valuable company in the world. And then number two, they said they're an AI company. So now they're the most valuable AI company in the world. I love it. I mean, I said before that Tesla's going to outperform Microsoft over the next 39 months. And I'm still holding to that quite a bit. So let me get to these charts. What? One. I guess the right one. So the reason why I wanted to run through this because there's the HOPE acronym. We've talked about that before. Housing, orders, profits, employment, hope, orders, HOPE, and housing orders profits unemployment. And this is from Michael Kantrowitz. He works for an institution as a lead economist, strategic economist, and he provided that acronym and shared it with the world. And so I'm using it because it allows you to look at the market and kind of have a context of what is the framework of it, and so it keeps you in check. So you look at housing. Is housing weak? That means the market's turning into it's going into a recession. Orders are weak. That means the recession is more likely. And then you get into profits. If they're weak, then the recession's highly probable. Then employment drops off, and then the Fed doesn't raise rates, and it drops off hard. However you define it, that would be likely a recession and a strong bear market. Now, if the Fed starts to raise rates, or cut rates currently where we're at today, and unemployment hasn't really done anything, that would be a very, very soft land. And we definitely had 2 quarters of GDP growth negative, right? So we had a recession. The question is, because I was listening to something earlier, and they're talking about how data is revised, so it's possible they could be doing some revisions in the future, and our numbers aren't as good as they appear. Because when you look at the ISM, or actually, let's click through all this. So we have the chart before this. Where are we? So we have, this is out of order. Anyhow, this is for manufacturing, and the trend has continued to drop off as expected. And then if we go over here, then we get into 30-year mortgage rates, and the mortgage rates have dropped off. And the reason why I have this in here is because prior I had a Michigan sentiment chart, and Michigan sentiment's actually improved a little bit over the last few months. So you could see rates coming down, and then you get a little bit of sentiment change. The price of gasoline dropping a little bit too. So the really outstanding question is food. So then we get into, so we're talking about hope, housing orders, profits, employment. So we're still on housing. So you can see permits have dropped off. It's quite amazing. Then you can see starts have dropped off, just like they should be. And then you get under construction is flat-lined. So they're not building a lot more new ones, or at least starting them. And then completed is just kind of not doing much of anything. And I did a lot of analysis on this, and what I discovered was that based on this ad hoc analysis, we have a lot of houses compared to 1980. I mean, this is really, I don't know, it was interesting, so we'll see. And then there's PMI dropping off, and then ISM new orders still dropping off. And throw this one in here. This is an important one. This is the 4-week moving average of initial jobless claims. And ultimately, this shows how tight the labor market is. And so if we slip over to here and you look at December 3rd, whoosh, so there's just a lot of people not filing for claims, and so the job market is tight. I think it's interesting to watch. And the reason why it's interesting to watch is because if the job market's too tight, then wages are going to go up, and if wages go up, then people spend more, and if people spend more, there's potentially price squeeze, and then if there's price squeeze, prices might go up. If prices might go up, the Fed might see that there's inflation, and then if they see there's inflation, they might want to raise rates. If they raise rates, then we know the cost of capital goes up, so the cost of getting new loans goes up. So that means the company that's selling a Pepsi is going to probably want to raise the price of Pepsi, so they'll raise the price of their goods, and the consumer will consume as much as they can. Then at a certain point, the marginal cost will it won't be profitable as much based upon the marginal cost to produce that incremental unit. And so then they're going to be in a situation where they can't raise price anymore. And so you got to look at laying off employees or cutting expenses internally. So they start cutting expenses, then they redo their budget, and then they consider doing a hiring freeze. Then the following year they look at laying off more people. So 2024, yeah. So that's kind of how it works. So raising rates is not a is not a direct cause to inflation. It transfers the money. So the Fed raises rates, and it does QE and QT. It takes assets out of the system, like they buy treasuries or they put treasuries in the system. So they're moving dollars in and out of the system. When they raise rates, they're essentially forcing people to shift their capital to different industries or different banks, and it washes out a lot of weak companies or even banks. But when they raise rates, it just flushes money and pushes it to other places. Like Ken Griffin just made like $16 billion last year. So I believe he used to sit on the New York Fed. So this guy, if he had any insight and knew in Q2 of 2021 that rates were going to go up, he might have started putting on a trade around July of 2021 to be positioned when the Fed raised rates and make 16 billion off of like 60 billion or so in 1 year. So I mean, sometimes you got to just scratch your head. So the Fed is on Wednesday. Employment data and claims and quits on Thursday. And then we have rig count on Friday. Rig count is important. The reason why it is important because we provide a lot of oil. Most of it, I believe, it is external. But the fact is, because we import a lot from Canada, and the Canadian dollar and the U.S. Canadian dollar and oil. I did some analysis and I found that oil has a strong relationship with the FX between U.S. That was the U.S. dollar and Canadian dollar, and that was many years ago. So anyhow, getting way off topic. So integrated oil companies are where you want to put your money. Rig counts dropping down. That means they're pulling less oil out of the ground. Even if you have a lot of rigs, if the land is saturated, meaning there isn't much oil left, you can't get it out. And so I watched a presentation by Shabam. It was like a 4-hour presentation. I maybe did an hour and a half or two. And bottom line, the oil drillers are in the U.S. They need to buy land because they're SOL. That's the drillers. Then you got the fully integrated oil companies. They're fully integrated. Like actually, ExxonMobil is one of the ones in Texas in the basin on the west side. I believe it was the west side of the state. And they were one of the few that like they didn't have a lot, but compared to Pioneer or EOG, but their well they didn't push it up too quickly. Meaning a lot of them would turn on the wells too fast, and then it drops off. And they all did that because they were running out of oil. A lot of them, the smaller private companies, and so. Yeah, but you saw that Exxon they turned their well on, but it just went up slowly, and they're still trending up where these other ones spiked up and down. So you're going to see a lot of bankruptcies in these smaller, well, maybe not bankruptcies, but there's going to be stress, especially with rates going up right now. So the oil companies, the drillers in Texas, if they're based out of Texas, they're not doing too well. And that is a function of them not buying new land, or if they did buy new land, they're not invested in it. But that wouldn't. Yeah, so we would. Yeah, I think there's a lot of complexity in it. And then what was clear though from all the data I saw was that once the government gets involved, you could see the whole oil market getting all funky in the last decade. When you could see their footprints in the data just because they can't plan as cleanly and smoothly. And anyhow, so that's good for the price of oil because it portends a higher price in the future. Bad for the drillers short term. So you want to look at the larger integrated or refiners. Regardless would do well. So where do we stand? We have tech reports. Meta, Peloton, Alphabet, Qualcomm, PIN. So PIN interest, PayPal. So Amazon and Apple report in a couple days. Yes. So that's one worth watching. Yeah, Apple has bought back, it was like a lot. I can't remember the exact number. Well over, I'm pretty sure it was well over $500 billion of stock. It was some ridiculous number because their market cap's over $2 trillion. And yeah, that just sounds too high, but I believe it was well over that, and I never verified it. But the fact is, Apple wouldn't have the price appreciation it has today if it didn't buy back its stock. And with the cost of debt being so low what it was, the the glide path for interest rates are such that if rates don't come down, a lot of these companies that were buying back shares to artificially hold, there's just going to be a big shift of the money's going to start to move away from the Apples of the world. I mean, yeah, obviously there's going to be exposure, but you're going to want to go where there's future growth, and we need infrastructure, we need energy, the world needs it, and you can't fight that. So where are we? So Shabam posted this. This is a commodity super cycles historically, going back to 1960. And you can see from 1960 to about 72, we were in a consolidation of commodities. And then it shot up for about over a decade or so. And then it went sideways for like 20 years. Wow. For a long time. And then shot up. And now it's kind of in a sideways range, and are we going into another super cycle? I don't know. I don't know enough about super cycles to talk to it per se, but we did break above the high of it, and given, like, you got to look at capacity utilization for one, and then population growth. But if manufacturing plants are constrained, like in the US we're at 80% utilization, and China is like I think around 76%, and then I should go from there and look down to other countries, then I could get a gauge of how much constraint is due to this on the supply side, and then you look at demand, which is a function of population growth and as well as resources. Resources in the ground is supply, but then you look at the population growth side of it to know and where the money is, and etc. So this is interesting. All right, the GB list. So the point of this is just to have a list to, I use it. I put companies that I find interested in here. It's a list, and I categorize it accordingly how I see it, and then you can do what you want with it. It's informational. So the buying power. So currently you could get a 3-month bond at 4.66%. That is pretty darn good. You do that for, say, 8 times in a row, or maybe not that many, 4, and then start to have fun in the markets. That's probably a good play, or at least a few times in a row, and see what happens. Southeast Asia opening. That whole area is open, so it's great for those smaller countries that surround it. The Philippines, even in Australia. Australia coal is involved in this. You got energy, XOP, XLE, so you're getting into one that deals more with the refiners, and then the other is more integrated companies. Metals and mining, you got uranium in here. You have all kinds of stuff. It's a nice little bucket. Eagle Bulk Shipping, they're a shipper. Shipping is currently, war potentially could help shipping rates if economies stay open, and it depends on the type of war. There are regulations coming out, and in 2023 a lot of the shippers are required to have these scrubbers. I'm talking about the bulk dry shippers, and if they don't have that, they got to cut their throttle by 20%. And so a lot of the good companies, like, well, I've done more research probably in Golden than Eagle, but they've been getting, so you want to, when you look at the shippers, see if they have the scrubbers, and then also see the age of their fleet. You want to look at that. And customer mix is obviously really important too. Do they have like some reliable customers in the routes, and are they covering Asia and other areas? Then certain shippers, the type of ship will only ship like certain types of things too. So it gets way more complicated. I didn't realize shipping was so complicated. I used to study coal, and this was many years ago, and coal is a lot more simple than shipping. I'll leave it at that from my perspective. Obviously, you got to have the demand for coal, but you could use a couple of indicators for that. Versus shipping is just, I didn't realize I opened up such a can of worms. Well, the shippers currently are all trading below book value. They all have really high, not all, but a lot of them have very high ROAs, return on assets. So they take their cash, they reinvest it, pops out as up 10 to 15% of what they invested. So they're not burning cash when they reinvest it with an ROA of less than 5% because there's inflation. Yeah, so any company with an ROA, return on an asset, of less than 5% is essentially underperforming. Yeah, wow, it's interesting if you think about it that way. Dry bulk shipping. This is the shipping rates. I put Z because they're putting me to sleep. Australian coal. So coal. Now these guys, I don't know a lot about Australian coal, but it's if you understand it, go for it. And if you're a technician, you probably could find some amazing trades. Event driven. The Bitcoin miners. Same story. Bitcoin is going to go to zero, so you don't want to own Bitcoin miners. Paramount Global. Buffett owns that. It's probably going to go to zero too. In all seriousness, on the two priors, Bitcoin miners are the machines that support the network in the sense that it provides security to the network. And for those that don't know about Bitcoin, you got Bitcoin the network, and then you have Bitcoin the coin. The network is a bunch of servers connected together essentially. And by connecting together, it secures the network and protects it so you can't hack it. Then sitting on top of the network, you get a Bitcoin. It just zips back and forth, which is just a form of value. And it allows you to move value from like the US and Japan. If you use the Lightning network, which is a layer on top of the Bitcoin network, you could zip it there in 1 second. And then if you want to do it on the Bitcoin network, you might have to pay a fee of like $1 or $2, then you can move $100 million. And that takes it could be 10 minutes. It just depends on the speed of on the network at that point in time. But it averages about 10 minutes per block, which is essentially a bunch of transactions on the base layer. So you have the Bitcoin network is the base layer of the network. So you have Bitcoin here and a bunch of computers connected, and they're just zipping around Bitcoin. So you can send $1 billion here, $1 billion there, $1 billion there, and it's secure. But there is a lot of transparency, so they could figure out who's moving it, where, and what. So it is actually good for the government in a way, at least in current state. And then you have the Lightning network that sits on the Bitcoin network, and that moves value as well, but it is done at a much quicker speed. And now they have a thing called Nostra, and that is essentially a protocol that essentially it's just program a protocol, and that could feed into Bitcoin. So it's designed to use I believe it's the Lightning network. And what's cool about that is you could have Twitter, like you know how you go on Twitter and they delete your profile. Well, Nostra, however you say it, is going to allow people to have a Twitter account, but you house the data in your essentially, I can't really explain it totally, like where the data is actually the data is stored. Actually, you could create your own server to store the data. So it gets a little bit more complex. So they're in the very early stages of creating it. So you could store your data on your own server, and then if you want to use Twitter, it could feed into your server. The data never leaves it, and they can never delete your account. Essentially, they're creating like a decentralized like Twitter as well that sits on Nostra, and they're starting to build all this stuff. So it's quite interesting. Safe Bulkers. They are a shipper. They have they're increasing their fleet by about 30% with new ships coming from Japan, I believe. I know their current fleet is all Japanese. I believe the new fleet with the scrubbers and the technology is Japanese as well. And so long term, that's another thing you would want to look up, the makeup of the type of ship, Chinese versus Japanese. Long volatility. What happened? So typically when the market drops off, the VIX will shoot up, and there's different strategies to go long volatility. And it's typically you want to go long volatility before the market like crashes. Yeah, I was in a meeting in New York, and portfolio manager had his feet up on we're in the boardroom, and he's like, go long volatility. And I was like I wouldn't know what he was talking about. And I was like, oh yeah, we should go to cash. And he's like, they don't pay me to go to cash. Anyhow, it was and then Bear Stearns and Lehman and all them blew up. So Central El Salvador. So I added this recently. El Salvador Yeah, El Salvador's doing good things. In South America, I put Brazil in, regardless of the politics. I mean, their data looks quite amazing from an economic standpoint. So I don't know enough about it. I don't live there. Nucor is an American company, all over the United States. I love Nucor, and I shouldn't say I love it, but I like it a lot. Like yeah, I got a much more due diligence to do, but I like what I see on the surface of it. Political lists. These are ones that just have a lot of political constraints. Like Zim Integrated, Zim, their fundamentals are just phenomenal. Huge dividends. Yeah, it's very interesting. Qualcomm, semiconductors. Yeah, I want to touch these guys, and I'd only my list has grown, but obviously you could watch my other videos. My do not like list: Amgen, Pfizer, Teladoc, Healthcare. They met some criteria, but they failed on a lot of others. So if like something changes, then I reevaluate them fundamentally, and from there I'll know whether or not I want to, if it's any good. Oh, and that is it. And I appreciate your time. So I do have a point to make still. So commodities. So with this whole story, and so I'll recap in case people don't want to sit there for 30 minutes, and I'll just recap part of it, the core things. But one of the key things here, what we're dealing with is the Federal Reserve. You don't want to fight the Fed. So what is the Fed looking for? It's looking at data. Psychology is key in this. And people are ignoring psychology. They're ignoring Fed might have an ulterior motive. They're not like looking at China, Russia. Like, does this play into that at all? Like, just general people. I mean, I hear a lot of people talk. I'm not saying everyone. So saying all that, the price of food, according to this, because I see Twitter, has gone up for the week. And I think that's extremely critical. A lot. Let's talk lumber. Lumber went up another 18% year over year, down 47%. So lumber continues to surge, which, I haven't seen any news about fires or anything of that nature other than what's happening in Europe is impacting lumber quite a bit. And then on the food side, I mean, you have butter down 11% year over year. That's like, how disappointing. But no, in all seriousness, we have sugar up 7% for the week, up 7 for the month, 16 for the year. You have coffee up 7% for the week, 2 for the month, down 27 for the year. Palm oil up 5%. I'm just rounding up. Wheat up 5%. Rapeseed oil up 5. Oat up 4, 3, 2. Canola. I mean, it's just like corn up 2. So all the foods were up, and I've made this point prior. Is like the consumer, because the Fed and the data was implying that there's a lot of services inflation. So if we continue to see this, they're going to be. I think it's going to make it that much harder for the Federal Reserve to battle inflation, because I think this will make it more sticky as long as food stays up, even if everything else comes down, because it's about psychology. One other item is the CRB index, which is commodities. That is basically flat for the week, flat for the month, and up 12% year over year. So that is like, I need to look up the makeup of it, but that is a great gauge of inflation because you're looking at straight up commodities. But the of any index, it's important to look at the composition of that index, because like the S&P might be heavily weighted Apple, and so Apple goes up, the S&P gets pulled up with it. So it's definitely like the US dollar index is approximately 66% euro, and then yen is whatever. I don't know what the yen is, 30% maybe, 20. So you got to look at things at the next layer down. So anyhow, so in summary, inflation is looking sticky because of butter. Now, butter was actually down a lot, but pretty much everything outside of butter was up a lot for the week, and that is not a good sign. And then as we run through all the economic data, the quick cursory review we did, I mean, housing's not going to turn around overnight. I mean, we just got to be real here. And so let's watch earnings play out over the next few weeks. But I'm still saying it's calm before the storm. That the technicals are looking quite good. I mean, but that's just a technical. In the market is the market, and you don't know. I mean, anything could happen here. So I'm calling this as we're in a chop, the calm before a storm, in a good chop. And this chop could be sustained for the next 12 to 24 months and go away, and we're sideways market. But a lot of this, there are a lot of parallels to 1980 from what I've seen. Just ran a few things, not much, and I haven't been looking for it. It's just boom, it correlates. So I think it would be worth researching 1980 and understanding that better. And saying all that, I appreciate your time. If you subscribe, like it or don't, and green bicep out of here today. Cheers.